Yeah, I wanted to go over a few stocks I have on my watch list to short in 2025. The first one is Red Robin. Those are the financials, income statement. Now, this company back in 2019 was making 1.3 billion in revenue. Then in 2020, now of course we all know what happened in 2020 with the pandemic, but what surprises me is that they haven't go back to that revenue in 2024. Now this 1.26 billion is the trailing 12 month, but anyways, it seems like they're still struggling to come back to the revenue pre-pandemic, which is quite weird, because I like their food. I really like it, and I hate to see Red Robin struggling, but it's exactly what's happening here. It's not only the revenue, but then the net income. They lost over 50 million, and again, this is the trailing 12 month. But as you see here, in 2020 they lost 276 million because of the pandemic. Then they kept losing money, and they're actually losing more money now than they did in 2023. So they lost 50 million. And let's see how much they've got. Total cash 22 million, receivable 11 million. Let's say that they can get a hold of 33 million, but I mean, if they keep losing 50 million, I'm guessing they only have 1 year of life left. And while I hate for this happening, I believe that it's enough to open a short position on Red Robin. Also, let me go and see how much they got in debt, net income, assets and liabilities. Now this company has about 200 million in debt. This is long-term debt. How much they got in the bank? And they got 30 million in the bank, according to the latest report. For me, this is enough to put this in my short selling watch list. America's restaurant chains going bankrupt. This is a wave of restaurants filing for bankruptcy. The other one was Red Lobster, of course, TGIF, Tijuana Flats. There are a few of those that they're going bankrupt. So I put it on my watch list. Also, I was watching an interview with the CEO.
Starbucks and KFC parent company Yum Brands all report seeing consumers pull back. And this week, Red Robin Gourmet Burgers reported earnings where the company is
We're in the middle of a comeback, is what we call it, and in what we call our strategic plan is the North Star plan. And so we see a little different than the backdrop of what's going on in the overall economy, because we're really driving back to some fundamentals of this iconic brand. And so what we're seeing right now is we're seeing a great take rate of our gourmet burgers, which, by the way, we've improved 85% of our menu with higher ingredients, and we're seeing a great take on the upper end of that menu pricing. Our more value-oriented tavern burgers, we're also seeing a great take rate. So we're seeing some trade down to tavern burgers, but that's okay because, again, we have great value with 30 bottomless sides. So we're seeing that, and then at the same time, we're seeing things like add-ons and salads and appetizers, desserts. We're seeing those hold steady. So I'm not sure quite what that says, but what I will say for us, it's just given us some confidence that, and as we reported positive sales for the first 5 weeks of the second quarter, we feel some good momentum. But again, I think it's a little different for us because we are in this comeback.
I mean, you have companies out there, competitors in this landscape that are saying, hey, we'll throw avocados on the burger. Hey, we'll throw, crispy onions on the burger. We'll, tinker with our fresh or never frozen beef patties. All of these things that are really the jousting efforts in your industry. Is it just becoming harder to innovate on top of the burger, especially in an environment where consumers are looking for value?
Well, innovation is a key part of any restaurant brand. You have to have that to stay relevant. And at Red Robin, we've been known for burger innovation for many, many years. So for us, I wouldn't say that's hard. But what I will say is that we have a value. Our check average is a little over $17, and it's a full service experience. It's not fast food or fast casual. So you get the whole experience. It's a fun environment. So for $17, we think that's still a good value. In addition to that, we have 30 bottomless sides that most consumers don't even realize, because if you talk about bottomless, they think bottomless fries. Well, we have 30 items that are bottomless, which is everyday value versus just, price promotions one after another like many of our competitors are doing. We think it's better to be 52 weeks a year providing value to our guests. So, when you look at it that way, we think that ultimately, again, our consumers saying that with what we're seeing in the momentum of our comp store sales. So we think we're doing the right thing.
All right, I'm about to come post up at a Red Robin and bake in some of those bottomless fries to my financial planning for sure, GJ. As you think about what you're hearing from your franchisee partners as well, what are they looking for from Red Robin and its leadership as they're trying to continue to keep the pulse of the consumer and engage across so many different regions?
Well, first of all, it's open communication, transparent communication, aligning around our mission, vision, and values, and what our North Star plan is trying to achieve. We have a really great group of franchise partners. They're great partners, and they operate phenomenal restaurants. And so, making sure that we're totally aligned and communicate. Their desires are, again, for us to continue to be out there promoting value, innovating value, innovating the menu all the time, but also staying the course where historically the company hasn't always done that. And so, with us and this North Star plan, we're staying true to what we're doing, which candidly, that's investing in more labor. It's providing better hospitality, better experiences for our guests. It's improving our burgers. As I said, 85% of our menu has been improved. We are continuing to focus on those fundamentals that get us back to the essence of what this iconic brand has done for so many years, to be at a place where we've got over 500 restaurants all over America. So I think that's what they're asking for. And again, I think more than anything is that open communication and listening to what their needs are and responding to those appropriately.
For me, it doesn't inspire confidence. This CEO, I see a discrepancy from what he says and his facial expression. It looks like he already knows that it's got failure written all over his face. So I think Red Robin is gonna come down eventually in price. Now it's trading at 5.25. Now this stock has already been going down over the past 5 years, over 82%. It's a risky bet because if a stock has already lost a lot, over 60, 70, 80%, it's not really a good candidate to short. You're already late to the party. But the recent gains were made November. This was the Trump rally. It went up to $6. It went from $3 a share, and this stock was really in free fall. And then with the elections and Trump was president-elect, it doubled. It went from 3 to 6. But again, I think there is a good chance that it's gonna go down. Also, the short interest, 13% of the float shorted. I think it's okay. It's not too much. There are a lot of people who think this stock is gonna go down, but I don't know. If you feel like shorting it, I would start shorting it very lightly, and then see what the stock market does in January and February 2025. Now, usually it's been said that if January is positive, it sets the tone for the whole year. I'm not quite sure about that. I mean, possibly that was the case, but I wouldn't go off of this data. But anyways, I would wait until January and February and see what the stock does, or the stock market as a whole. The other one that I had on my watch list is Lemonade. Now, Lemonade went up recently for the same reason, for the Trump rally. This stock was trading about $11 a share. From $11 a share, this stock skyrocketed to nearly over $51 a share, and now it's down to $41 a share. Now this company's got a 22% nearly of float shorted. This is a new stock, a fairly new stock. I think it's been trading since 2020. The pandemic, it went up a lot, like all the IPOs, and now it seems like it was in free fall. Now this one stock, I believe that this is a little short squeeze. Eventually the stock is gonna crash down again. Also the financials. The good thing about this is that they're increasing revenue year over year, but they lose money. They lost over 200 million in 2023, and trailing to a month they're on track to lose 250 million. I mean, this stock could be going down a lot. They got 640 million in the bank, and how much they got in debt. The income statement, assets and liabilities, they have no debt. But anyways, this company is losing quite a bit of money. I don't know why the stock went up a lot. It was going up with all all small cap stocks. The Russell 2000 went up a lot since Trump was president-elect. In fact, here, this is the Russell 2000. It went up from, it was down to 80, and now it's 90. This tracks the Russell 2000. Now here it was down about $80 a share. Then it went up a lot, nearly $100 a share for the Trump rally. But again, I believe it's gonna test again the lows of $80 a share, and it's gonna drag all of those small caps down with it. Also, I was watching an interview with the CEO of Lemonade, and I'm not really with him. No, this is from a month ago.
Shares of Lemonade ending the day higher as investors await the company's Investor Day tomorrow. Lemonade is expected to break down how it will grow the business from $1 billion. Customers are out now shopping for new providers with rate increase notices going out. How has that affected your growth, and how is your technology foundation positioning you to be efficient about it?
Great to be with you. Our growth has been accelerating. So this time last year we grew at 18%, the next quarter at 19%, then at 20%, then at 22%. This past quarter announced at 24%, and we've guided to a 26% growth this Q4. So steady and rapid acceleration in our growth. And while we're doing that, the underlying unit economics are improving. We achieved cash flow positivity just this last quarter, and that will be sustained. And really, the advantages of all of the AI that we have built is being passed on to the consumer. So we're seeing massive automation. I mentioned 24% growth in our top line, but actually our headcount has been shrinking over the course of the last couple of years. OPEX totally flat and headcount declining, even as we've been growing 50% over 2 years. So you're really seeing the dividends of AI on automation play out in very powerful ways at Lemonade.
So how do you grow really at scale without massive marketing spend? I mean, it seems like you got to have a gecko or a duck or a general or something to break through after a certain point.
Well, Lemonade has a distinguished brand. The pink that you're seeing behind me makes us look different. We've got a different value proposition. We appeal to younger consumers with an entirely digital experience. And we also pass on the savings to them. 98% of our policies are sold by an AI. The majority of our claims are paid instantaneously by AI without any human intervention. And that achieves two things. One is tremendous brand acceleration. Consumers love that. They tell their friends. High net promoter scores, which translates into organic growth. And at the same time, lower cost structures, which allows us to pass on savings to consumers. And you get that feedback loop, which really only technology can provide.
So you got a pig, John. There you go. Daniel, it's great to have you on. You're in homeowners insurance, renters insurance, pet insurance, auto insurance. We know, and this has been particularly true on the auto insurance side, that this has been continued to be very inflationary. The premiums have continued to go up, in some cases very dramatically, and the rates. Have we seen the peak? Is it in? Does that start to normalize, dare I say?
Yes, I think so. As inflation rates have come down, as rates increases have kicked in, yes, I think we have peaked. We see that in our own results. Our loss ratio 2 years ago was a very elevated 94% because of those inflationary pressures. We just reported a 73%, which is smack bang in the middle of our target range. So mission accomplished in that side of the house. For us specifically, we have other things that allow us to target risks at a level of particularity and precision that are usually absent in the insurance space. So we're now in the 11th generation of our LTV model, which is basically a composite of 50 AIs, and every consumer that comes in, the AIs make predictions about their likelihood to claim, the size of the claims that they'll make, likelihood to churn, cross-sell, and then you're able to extrapolate a lifetime value and decide which campaigns to invest in, which consumers to invest in. That kind of efficiency does translate into better prices for consumers as well. So as inflation is coming down, I think it was Warren Buffett who said that when the tide goes out, you see who's wearing a swimming costume. We're beginning to see those kind of dynamics. So the huge pain point of inflation is receding, and now you begin to see who's got really the better technology, the better, more prescient systems in place in order to price risk with precision.
So looking at 2025, what does a Trump administration mean for the insurance industry? We were just having a conversation with Randy Quarles about what he's expecting in terms of regulatory changes to the broader financial environment. What kind of policies do you want to see? What are you expecting?
Well, the insurance space is actually governed entirely or almost entirely at a state-by-state level. So we work with 50 different regulators. Really, none of them are federal. But I will tell you that if you look at Lemonade's results since our IPO 4.5 years ago, or for that matter, since our inception 8.5 years ago, you'll see a very steady up and to the right performance, and you'll be hard-pressed to identify any of the tumultuous events, whether it's COVID or the inflation or any of the other massive disruptions and changes of government. We've really been able to prove the industry, and specifically Lemonade, hugely resilient to those kind of changes. So we're looking forward to a dramatic 2025 with continued growth, increasing profitability, growing our customer base. We don't really expect changes at the federal government to impact our business directly or to derail us or accelerate us in a way that we aren't already doing.
If self-driving cars become a reality more and more over the next few years, what does that do to the auto insurance business?
Well, I think if you're sitting on a $50 billion auto space, like Geico or Progressive or many others, that is an area of true concern. You're suddenly pricing based on proxies like gender and credit scores and that kind of thing, and suddenly you're not even sure who the customer is, and it might be an algorithm that's doing the driving rather than the consumer. It may be fleets. Everything changes, and I think over the medium to long term poses something of a risk to huge incumbents. Lemonade is in the auto space, but entirely on a telemetry-based business. In other words, we use continuous streams of data in order to price insurance, whether it's consumer driving or an algorithm driving, we don't really mind. And for us, the industry is unlimited, or at first approximation, unlimited in scope. We could 10x our business, 10x it again, and would barely be a blip on the market share. So for us, whether the $300 billion auto insurance market grows or contracts a bit, for the next 10 years will have no impact on us at all. We think we're very well positioned as a technology first, telemetry first, AI first insurance company to adapt to all of those technologies as they emerge.
Shares of Lemonade.
I just don't buy it. It doesn't inspire me confidence. I think the company is on the right track, but the stock price is ahead of itself. I definitely believe that this is a little of a short squeeze, and then eventually the price is gonna come back down. Again, it was trading at 19, and it went up to 52, 41. Those are the short sellers covering, and that's why the price went up. But I believe, and again, do your all due diligence if you are thinking of shorting. The company itself is not bad, I don't think, but the stock price is enough for me to put in my short selling watch list. The other one that I was gonna go over again in the restaurant category is Jack in the Box. And now this stock is already down over 50% over the year. It's already got beaten down 10%. The flow shorted over the past 5 years. Again, it's down 50%. And that's really bad. I mean, when you see that the whole broad market is going up, and this stock is actually going down, I don't know why. I like their food. Now this one in 2023, 1.6 billion revenue, 1.5 trailing 12 month. The net income they made in 2023 $130 million, and then in 2024 they lost nearly 40 million. This is another one that it's an early stage. They only got 25 million in the bank, 84 million in receivables. It's a risk. I mean, I don't know what I'm gonna do with this. It could be a good candidate for shorting it, but because it's already went down quite a bit, I'm gonna leave it in my watch list and see what it does. Now, over the past, this stock hasn't really participated to the Trump rally. Actually, it has been going down. It might go further down. Not sure. I'm gonna leave it in my watch list for now. Let's see what the CEO has to say, if there is like a recent interview with the CEO. 11 months, 3 years. The rise and fall and rise again of Jack in the Box. A lot of times I can tell from the CEO, not what he says,
Jack in the
but
Box
his facial expression.
The company which operates franchises, Jack in the Box, or brands, I should say, Jack in the Box and Del Taco, plans to spend more this year as it moves to become a more heavily franchised asset-light company. Joining us now in an exclusive interview, Jack in the Box CEO Darren Harris. Darren, it's so great to have you on. There's so much to get to. I am going to start with this refranchising push that has been afoot and that you've been employing pretty aggressively, and it looks like it continues. What is the financial, I guess, argument for why it's so needed and so compelling for the company now?
Yeah, I think it's all about growth. So for us, it's about becoming an asset-light model where we sell locations to franchisees who have a desire to build and invest capital for future growth. So for us, it's a model that we think over the next 3 years we can get to a very 90% or plus franchise model. And enables us to continue to with our growth strategy.
So in terms of, and of course you're joining us from ICR down in Orlando. You updated investors today as well. What are you seeing in terms of consumer appetite, pardon the pun, at Jack in the Box and Del Taco, and how does it speak to how you would assess the health of the consumer right now?
Yeah, I think overall what we're seeing is a consumer who, if they find the right offer at the right time, are willing to come to our restaurants. And we're in a very competitive marketplace in QSR, and so for us recently, we're excited about a recent rollout of our Smash Jack. We call it the best burger in QSR, and we've got a claim to that. And we're seeing consumers being willing to pay for a really premium product and something that's differentiated in the market. So I think it's all about a very resilient consumer who is looking for the right offer at the right time, and we've been trying to focus on Jack in the Box meeting their needs.
What about your costs and wages, especially in California with the minimum wage going up? How is that affecting your business?
Yeah, I think overall what we've seen is inflation normalize. And we continue to be within our guide that we've got between 1% to 3% in overall inflation. We are facing AB 1228 in California, where it'll definitely have a wage increase, and we focused on how do we mitigate costs, but also how do we take price to make sure that we can manage the business effectively.
So that's the labor piece of it. I'm curious about the food inflation piece of it. In a week where we're awaiting the latest CPI report on Thursday, we have started to see food prices, or the increases in food prices slow down. Is that what you're seeing within your own cost structure, and how do you expect that trajectory to play out this year?
Yeah, as I mentioned, we're meeting within our guide of 1% to 3%, so we have seen some costs come down related to food inflation.
I don't buy it. Not for me, but I'm gonna leave it in my watch list and see what it does. But it's already gone down a lot. Another one is NGL. This is energy and gas, or rather oil and gas. Let's see now. This one, it's down a lot. This is down from $30 a share. I think it went down to nearly $1 a share at some point. Then recently it went up for the Trump rally. This stock was in free fall. It was $4 a share. It went up to $5. Now, of course, this company price is strictly related to the oil price. So usually I'm skeptic because something happens with the underlying commodity that's gonna change everything for the stock price. People are gonna overreact to it, and it's gonna go up a lot or down a lot. But for me, this one company is another one that I have my watch list of stocks to short. This company revenue in 2020 was $7.5 billion, and in 2024 $6.9 billion. So they're still to go back to the 2020 revenue, which is quite weird. But more than anything, this company in 2024 lost nearly 150 million, and trailing to a month they're down 180 million. So they lose money. They lost 180 million, and they only have 4.5 million in the bank. Wow, this company, now they do have 735 million in receivables. But I feel the struggle of this company. I've had it in my watch list quite some times. I think they used to pay a good dividend, and now they actually first they cut the dividend, and then they don't even pay a dividend now. Now this was a great company for a dividend investor, but when they cut the dividend, the stock price collapsed because the shareholders, they were only in for the dividend, and when they cut the dividend, everyone sold by the bulk and causing the price to spiral down. But that's the other reason why I don't do dividend stocks, and even more so I don't do high dividend stocks, because if they cut the dividend, the stock price might fall 50, 60, 70% overnight. So I wanted to mention there. The other thing, I think this company has quite a bit of debt. Let me see how much they got in debt. Assets and liabilities. Now remember, this company has 4.5 million in the bank, which is nothing for a company like that. It was making 7 billion in revenue, and they only have 4.5 million in the bank. And on top of that, according to the latest report, this company has nearly 5 billion with the B, 5 billion in debt. So I don't know. I leave in my watch list of stocks to sell short. And I'm gonna move into the next one, which is Wayfair. Now Wayfair, over the past 5 years, they're down a lot. They're down over 50% over the past 5 years. This is really bad. I don't really know if I want to short this. again, because when a company is down, you're late to the party again. Now recently it was down to nearly $40 a share. It went up to 55, down again to 40, up again to 55. I think this company is oscillating up and down. I can see this company breaks down at the $40 support. It might really crash down. I'm not really a huge fan of the e-commerce, because I believe that the Amazon is the leader on there. Now in 2020 they were making $40 billion in revenue when the pandemic and everyone was buying online. Then 13.7 in 2021, and the trailing 12 months they're only making 11.8 billion in revenue. And of that, a company that makes nearly 12 billion in revenue, and now they're losing over $500 million. $500 million. How much they got on the balance sheet? They got 1.3 million in the balance sheet, which is not bad, but I mean, if they don't change things, this company has 2 years of life left. Also, I was watching an interview with the CEO, and same thing. I don't trust it. This is from 5 months ago. I hope there was a recent interview, but I don't see it. Let's see. This is from 5 months ago.
The original recurring revenue business, no longer going, and you know, that type of thing. And so I would say it's always something I was excited by. At Cornell, is the one version, of course, they had at the time. Today they have a few hundred, but we took it our senior year, and we ended up starting a company right out of it, and that's kind of how we got started. Push through. You know, there's through the various businesses we started, there's been a number of, I'd say the biggest one on the Wayfair journey that sticks out is a little later on. It's when, 10 years in, we raised capital for the first time, and the reason we raised capital was in order to launch Wayfair as a brand. And we come to the conclusion that there was a really big opportunity to build a go-to brand place for all things home, but just the cash flow generating from the operation was not going to be enough to make that happen. And so we raised outside money. We kind of went through the process of launching this new site, Wayfair.com, closing these microsites that we had built over a decade. And as you can imagine, things just did not work. Trying to redirect the traffic, we're losing tremendous amounts of search placement, the conversion on the traffic's not what it was. And you're just like, oh boy, it's kind of like, but you're kind of past the point of no return. Your thesis is right, but you're not in a great spot. And I think our view was, hey, and this was the view of the whole senior team, was like, hey, we need to figure this out. We just keep pushing. And that was like, in hindsight, probably a year and a half, relatively nerve-wracking period. One of a number of them, but there've been a few of those along the way.
So you alluded to the fact that you were actually bootstrapped for like the first 10 years of Wayfair's journey. We get asked quite often in our capacity as investors, like, when should I raise money? When's the right time? I will often tell an entrepreneur, and it sounds like this was your thought process, raise money once you have a good use for that capital, and it sounds like that was really the primary motivating factor for you. I'm sure your phone was ringing a lot during those first 10 years as you were making progress on that march to 500 million in revenue. Did you just shut out the noise and not take calls from investors?
Yeah, and I think the thing, part of bootstrapping the business is you definitely do create scarcity. Because, what you can afford for the size of the team the seniority of the team, it's pretty limited. And so what you're going to do is you really need to focus on what matters and the execution of that. And so you do. You make sure that you're spending your time on those things that are going to grow the business and drive the business outcomes. And that forcing function, I think, actually helps with execution, helps with getting the outcome you want. But as a result, there's a lot of things you don't spend time on. Not because they wouldn't be interesting, and not because they wouldn't, you wouldn't learn something from, but just your scarcity of your time. Your time. You don't have many other variables, and so you just got to take the time and put it against the things that matter.
I have to imagine your job has changed a lot since the business started in 2002. I'd love to just hear your description of how your role as CEO has evolved from bootstrap founder with an idea to publicly traded company with over 10,000 employees.
Totally. So I would say it's changed. Numerous times, I guess, would be the kind of quick answer. It was never sort of deciding it's time to change it. What should I change? For me, it was kind of a journey, and it was sort of like, hey, what is it that makes the most sense for me to do, and to help the company flourish. And as you get bigger, you realize that some of the tendency to do certain things yourself would actually hurt the company's ability to progress. And so that sort of
popular conversation topic amongst investors and entrepreneurs that sometimes it's not the same team that gets a company from 0 to 10 as it is 10 to 100 and then 100 to billion and so on and so forth. Was there anything you did proactive to make sure you were evolving and adapting and keeping pace with the company and making sure you're meeting the needs of the business as it scales?
Yeah, I think I was always a big fan of reading biographies. One of the types of biographies I really enjoy are business leaders. And what I like about the biographies is really, the autobiographies, they tend to tell you the story of their life in a way that's not necessarily the same headlines you maybe are aware of the company, because what's stuck in their head or some more subtle and nuanced things, but that were really informative for them. So I feel like you can always learn a lot from that. I feel like I learned a lot from that. And I would say the other thing that helped us a lot is that, the idea of the job evolving and changing, and the goal being that the company was succeeding and growing, that always got me very excited. I know some other founders, they were very clear that they really enjoyed doing the work, and so then as that changed, it was not enjoyable to them. And so I think that's a tough setup, because I think you're only going to really be great at things you enjoy. I got a little lucky in that I enjoyed the journey of my role changing, and I enjoy what my role changed into. And so I think that sometimes is a challenge. Obviously, trying to do it, if you're not doing it well, can also be a separate challenge. But I guess we got lucky with how it worked.
Quick shout out and recommendation on your point about founder biographies. There's a great podcast run by a guy named David Senra, Founders Podcast, where he reads biographies and then summarizes them back in 45 minutes. And there's so many amazing lessons in those stories of successful entrepreneurs and their journey.
Their journey.
Surround themselves with talent and folks who have functional expertise. We have a talent team internally at Volition and try to help folks with that. We're constantly learning. Has your approach to kind of recruiting and hiring in talent changed at all over the years?
I think the core goal we have is the same. I think we've learned how to be more structured. So here's the panel of folks who are going to meet that person, and you sort of divide up which person's going to focus on what particular traits or areas we're trying to probe on. So I think we've added some finesse to it, but ultimately no. I mean, it's still the same underlying goal and approach.
Entrepreneurship, and I think the image of being an entrepreneur in society is sometimes like glamorized and lionized. We work with and talk to entrepreneurs all day, every day, and understand the challenges that go along with it, behind the scenes. I'd love to get your perspective on just some of the misconceptions about what it is to be an entrepreneur for those folks that are early in their career and thinking about maybe taking that leap.
Yeah, so I think if there's something, you have an idea, you're passionate about it, something you're going to enjoy doing, something you're good at, you're willing to really give it your all. For someone who really wants to do that, there's nothing more exciting than pursuing that, working very hard to build that business, build the team that powers that business. I would also say that, I know a lot of folks where that's just they would associate some of the unknowns and the stress and the turn twists and turns in a way that they just say, I'm not going to enjoy that. And I would say it's not something to pursue if you don't think you're going to enjoy that. And so it's like anything else, you got to figure out what you think you'll enjoy. Growing up, in a family of Indian, there's a lot of the kind of de-risk successful career paths would be to become a doctor or a lawyer. Well, one of the things I realized pretty early on is, I find science fascinating, but I didn't have interest in being a doctor. So I don't think I would have been a very good doctor. And so it doesn't make sense to try to become a doctor if you're not going to enjoy it, because how are you going to give it your all? How are you going to work at it every day? So I think being an entrepreneur is not particularly different than any of those things. It comes with different pros and cons. I think it's you got to be careful not to try to pursue anything because someone tells you it's a great idea. You got to figure out what you would enjoy.
It sounds like you're fortunate in that you found something you enjoyed, you pursued it, and made a career out of it. What do you enjoy the most about your job today? What keeps you coming back?
Yeah, so on one hand, we've had a bunch of success with Wayfair, or household brand name, we've grown to 12 billion revenue. On the other hand, we view ourselves as pretty small.
I've listened to this enough. Look, I don't buy it. I don't think Wayfair has got any advantage on all those others online retailers. At least me personally, I don't see it. This is their website, furniture, outdoor, bedding. I really don't know. I don't remember if I bought anything from Wayfair, maybe once. But what would you buy through Wayfair? Help me understand. The other one was Peloton. Let's go look at Peloton. And now this is another one of those hype stocks that went up in 2021, I believe. Let's see the income statement. In 2021, they made a revenue of $4 billion. And the latest report, 2.7 billion. It's quite a bit of drop there. Not something I want to see. They lost in 2021 nearly 200 million, and now they've been losing nearly 400 million, which is twice that on a less revenue. Now this company is only speculation. They can't really make a good treadmill. They've had problems with it. This was one of the hype stocks of the pandemic, along with all the Cathy Woods stocks, Roblox, and Teladoc. When people thought that they couldn't leave the house, never ever, and people were lock themselves in the house and work out from the house. Now this stock participated to the Trump rally. They went from $4 a share to over at some point $10 a share, which is 150%. I believe that this stock it'll come crashing down again. When the Russell 2000 and all those, so they're gonna come crashing down again. It was this Trump rally is gonna end, and the Santa Claus rally is gonna end. This is one of those candidates that for me it's gonna come crashing down hard. I don't know. I'm gonna leave it in my watch list and see what it does. But for me, this is a little of a short squeeze. Short sellers covering it. Over the past 6 months, this thing has skyrocketed. I don't think the trend is gonna continue. I mean, this company has pretty much the same revenue, the same income, the same employees as they did 3 months ago, and their stock price has skyrocketed. I feel this is a lot of chaining activity, a lot of people trying to make a quick cash, a quick trade, but when then there is gonna be a incoming pull rug, that's when the same people are gonna sell by the bulk, and this stock is gonna come crashing down really hard. Now the other one I was gonna cover is Context Logic. This was the old Wish, the company who bought out Wish, but I mean this company too went up a lot for the Trump rally. Now it's coming back down. The financials, they totally suck. This company was making $2.5 billion in revenue, and now it's only making $96 million in revenue. And the losses, they're gonna be losing over $140 million. How much they got in the bank? $150 million. They don't have any receivables, so pretty much this company has 1 year of life left. The only thing, this company has already lost a lot, has lost everything. It used to be over $750 a share, and now it's $6 a share. This man, I don't know if shorting it, only because this company has already lost a lot. But what comes next is possibly that this company is gonna translate in a penny stock, eventually get delisted from Nasdaq. But take it with a grain of salt, because when a company has already lost a lot, once again you're late to the party. CT Trends is the other one I was looking at, but I believe the same thing applies. So let me just see. Yeah, once again, this company used to be like over $100 a share in 2021, and now it's down to 26. But in the reality, this company was down to 15 to 14. So it went from 100 to 14, then it participated to the Trump rally, to the madness, and now it's up to 26. But this company, in my humble opinion, it'll come crashing down again. Revenue is slightly down. The net income is down. They lost $25 million. I'm on the fence. They have about $40 million in the bank. That's gonna mean that they only have a year and a half left of life. So I don't know why people keep buying this company, other than speculation and a lot of chaining activity. But I don't know. I see this company like a struggling company. Cash on hands. Again, they possibly have 40 million on hand. Yeah, 40 million. The debt. They paid down their debt. According to that, they have about a year and a half of life left. So that's another candidate to short sell. Let's look at ETD. Ethan Allen Interior. I think this is one of those companies that I already covered. They have about 140 million in the bank. They are losing actually they are profitable, but the income is trending down, the revenue is trending down. They went from 817 in revenue to 636. I think you might still gonna be able to get this company on the way down before it crashes as hard. In the 5 years, I mean, they're pretty consistent about $30 a share, but a bad news, a decrease in revenue, and this company might come crashing down. So I have it in my short selling watch list. The other one, Scholar Rock. Now this company went up a lot. It used to be like $7, $8, $9 a share, and now it's 45. There was a good news here to where one of them drugs got approved. It was close to getting approved. The stock price skyrocketed. Then again, it participated to the Trump rally and all that madness. But I think the stock price is ahead of itself. This company loses 200 million a year. They got 140 in the bank. They got no receivables. So again, if I'm going off of this data, this company has 1 year of life left. The other one I was gonna cover is Office Depot. $180 million in the bank, decreasing revenue. I mean, I don't think this company is bad. They made nearly 10 billion in revenue in 2019, and now they're struggling. This is a decreasing revenue from 2021, 2022, 2023, and the latest report, it's been decreasing. So when the revenue is decreasing, guys, this is a bad sign. And on a decreasing revenue, now recently they lost 37 million. I don't know, it seems like the company is struggling, going down. They lost about 60% on the year. You might be late to the party. You might really be late to the party. Oh no, really don't know about this. If there is a recent interview with the CEO, I wish I can watch it. Yeah, I don't see a recent interview. The latest, it seems like 6 years ago, 5 years ago, 6 years, 4 years ago. Look, I don't know about this company. I leave it in my watch list. But I believe that anything that you can buy on here, you can buy on Amazon. So why would you? I mean, if you can buy anything from Amazon, everything for your car, for your personal life, for your business life, for your office supplies, your house supplies, why would you go and buy the same thing from Office Depot? So I don't know. And the other one that I was gonna cover is Mesoblast. Let's see, Mesoblast, what they do. This company has gone up a lot. I think a bit of that was this security is hard to borrow, but it's got a decrease in revenue. Revenue is going down by a lot. Net income, they got 60 million in the bank. net income, they lost 88 million. So this company, according to this at least, they have less than a year of life. I don't know, it's a risk showing this because it keeps going up. I mean, it went up like since April 7-fold. So it's almost scary, but it can be a little bit of short squeeze. This is one of the most shorted the companies out there, so I would be very careful for shorting this. But I'm gonna wrap it up with this one. I hope I gave you guys a little bit of food for thoughts. If you are thinking about shorting any stocks in 2025, I'm still bullish on 2025. I believe that the S&P 500 is gonna go up. I mean, possibly it's gonna close 2025 nearly 7,000. I believe I estimate between 6,600 and 7,000. I don't think it's gonna have a huge gain like it did in 2024. But I can see 6,600 for the S&P 500. So I'm gonna wrap this up, and I'm gonna wish you Merry Christmas and happy trading, everyone.